Welcome everybody. Thank you for joining us today in the latest Boutique Hotel News webinar. And today we're going to be talking about refinancing in a high rate market. My name is Eloise Hanson. I'm the editor of hospitality for Boutique Hotel News. And if it's the first time you're joining our webinars, Boutique Hotel News is an online multimedia trade publication covering the global boutique, lifestyle and luxury hotel industry. Today's webinar is actually the first of a new series sponsored by Agilysys. And Agilysys is a hospitality technology platform specializing in gaming, hotels, resorts, and cruise. And to provide some background, we have Matthew Prosser, Senior Sales Director at Agilysys, on the call today. So Matthew, let me hand over to yourself. Thank you.
Oh, thank you, Eloise, and thank you very much for this opportunity to sponsor this particular webinar. It's great to be part of what I hope is a very meaningful conversation. Look, from my perspective, financing of new hotels and redevelopments is a real challenge in today's market. You know, we're facing higher interest rates, inflation that's only just beginning to return to normal levels, and I guess in general terms, a global economic uncertainty, not to mention what's going to happen, you know, before or after the 4th of July. From my perspective, I think lenders are likely to remain cautious. I believe they'll prioritize projects with strong fundamentals, and I suspect proven management teams, i.e. executives that can demonstrate a portfolio of historical success. Borrowers, on the other hand, may need to demonstrate greater financial resilience and adaptability to secure favourable financing terms. Today, strategies for hotel financing means that business plans have to be tighter than ever before. Relationships with lenders need to be strong, and funding sources need to be creative, such as debt, equity, and crowdfunding. With that in mind, I'll now hand back to Eloise, where I'm sure the experts on this particular panel will impart their own superior knowledge and opinions. And thank you once again to Boutique Hotelier for this opportunity to sponsor the event. Back to you, Eloise. Thank you.
Thanks, Matthew. And Matthew's details have been popped into the chat if you would like to connect and learn more about Agilysys. And on that note, let's meet our speakers today. And I'm going to ask each of them to introduce themselves, moving from left to right as per the PowerPoint slides on your screen. So, Philippe, welcome, and let's kick off with yourself.
Thank you very much, Eloise. So I'm an investment banker by training, focusing on hotels and hospitality for several decades, working with various intermediaries such as Rothschilds, Brookfield Financial, and latterly JLL, where I was in charge of the EMEA Hotels and Hospitality Advisory and Brokerage team. And more recently, I've been working as a consultant and advisor to private equity firms and helping operators and owners raise capital.
Thank you, Philippe. Dan, over to you next, please.
Hi, I'm a general practice partner with Hawsons Chartered Accountants. I have a relatively large leisure and hospitality portfolio within my general practice. I look after a number of multi-use hotels, as well as other leisure venues and associated companies.
Super, thanks, Dan. And Gary, you next, please. Welcome.
Hi, my name is Gary Harden. I work for Christie Finance in our debt advisory arm within the larger group of Christie & Co. Christie & Co, the largest UK and European by volume hotel sellers, and supported by a valuation team and consultancy team. Historic background, 20 plus years with banking, Lloyds Bank and Bank of Scotland before joining Christie Finance.
Thank you, Gary. And last but not least, Lior, over to you.
Hi, I'm Lior. I'm working for Aareal Bank. We are one of the largest lenders for hotel financings with around 12 billion of loans under management. Traditionally, from my background, I come from property development, and then I was working 5 years for Deka and taking care of their hotel portfolio.
Thanks, Lior, and thanks to all of you for those introductions. Side note here that all the LinkedIn profiles of our speakers have been popped into the chat. We've got a lot to dissect today. We may not entirely cover everything, so please connect offline and carry on that conversation after this webinar has finished today. And a quick overview of how today's webinar is going to run. We'll spend around 45 minutes in conversation with our panelists today, followed by some time to take some questions from the floor. So if any of our audience members today have any pressing or burning questions, please submit these using the Q&A function at the bottom of your screens, and I will keep my eyes on that chat and I will ask as and when relevant. And a gentle reminder that this webinar is being recorded and everybody that has registered will receive a copy of that recording within 48 hours. So to provide some context to today's conversation, the stories or the headlines on your screens now have all been taken from Boutique Hotel News. And this particular slide shows some recent examples of financing or refinancing deals. And early this year, we saw Aareal Bank provide finance to Starwood for the acquisition of the majority of the Edwardian Hotels portfolio in London. And those hotels operated under the Radisson Blu brand. On the independent hotel side, Country Townhouse Hotel Beaverbrook in Surrey secured a £52 million loan from Oak North Bank to refinance its existing facilities and to fund expansion. And those two deals have happened earlier this year, January and February time, I believe. And then towards the back end of last year, and what was one of the largest financing deals of 2023, Generator completed a €750 million refinancing deal that executives said will permit the brand to expand. And on the next slide, these are examples, maybe looking further ahead, looking at opportunities on the investment side, on the sale and acquisition side. So we recently covered news that the Pan Pacific Seattle Hotel will be repositioned into the One Hotel by next year. And it certainly highlights the value of a brand in finance and investment strategies. And then at the other end of the market, 18 economy and mid-scale hotels have been acquired by Ares and EQ Group, where some of those properties are going to be refurbished and also repositioned. And what I'm hoping to dissect at some point today is whether refinancing pressures may lead to hotel sales. We saw that the owner of Virgin Hotel Glasgow has put the property up for sale as a result of financial difficulties. So there is lots to get our teeth stuck into today. I hope that's provided some background as to why we are hosting this conversation. And let's move on to talk about refinancing. And I would like to kick off our discussion today by asking each of you to provide a snapshot overview of current market sentiment under the umbrella of refinancing and how you see this evolving over the next year or so. Gary, I can see you are first on my screen, so let's kick off with yourself.
So there's obviously been a huge amount of volatility over the last 4 years post the pandemic. The rebounds have been disparate geographically and urban versus provincial-based hotels. The refinancing position is tough, it's nuanced, and it very much takes into account everything from the management, the affordability of the debt proposal, and the security that's potentially on offer. I don't think that's going to change quickly within the next 12 to 18 months. So I think that's a nice summary as to the current position from my point.
Thanks, Gary. Philippe, you're next on my screen, so your thoughts, please.
Yes, I obviously totally agree with what Gary has just said. I think what's very interesting is that there's definitely been a change compared with last year. In other words, last year was a year when lenders were trying to do some work on what they saw as their problem loans. They were very much focused on this rather than on loan origination and if refinancing took place, it was under duress and it was an awkward and painful process. When you talk to people in the market, the impression you get is that process is now largely complete, and that lender liquidity, has recovered quite strongly. So that suggests that there is going to be more appetite on the part of the lenders, maybe even more competition, which obviously in the context where interest rates are starting to come down in Europe and as of last week and may do so later in the year in the UK, provides a more favourable context than we saw a few months ago.
Thanks, Philip. Daniel, what are your thoughts?
I think aside from the comments so far, I think the other aspect to that is necessity as well. I think there's about, I think it's 43 billion of hotel debts due for refinancing by the end of the year. People have been sat on their hands waiting for the interest rates to come down, waiting for a time for it to be more favourable. And to all intents and purposes, they're now running out of time. So I think interest rates are looking like they're coming down. Obviously, dependent on how things pan out in terms of the general election mid-year. But I think we will start to see those transactions coming through. Albeit, I think they will probably take more time. Because certainly from what we're seeing, lenders are having to go through more due diligence, which certainly something we've been assisting our clients with as part of that process, really.
Thanks, Dan. And Lior, your thoughts, please.
We can slowly see that there are more projects coming to the market. They all over, like, to give a summary, I think they take longer these days for the transaction to be completed. And we can also see more new buyers on the market that haven't been known to hotels yet. I think one of the reasons is that offices don't work at the moment and people are staying away from it. So you can see first-time buyers. In general, there are not enough projects in the markets that we can see because there are many buyers interested in the same products, and there's still a bid-ask spread. So yeah, that's what we see at the moment.
Do you see that narrowing in the next 6 months?
To be honest with you, everyone is waiting for NPLs since years, but I would say that our financings are quite stable. I think we have an average portfolio LTV of 52%, and most of them have quite a lot of equity. I don't know how this is with other banks or lenders, but I don't think there will be a wave of NPLs as long as the financings are being done on a solid basis. That's what I see, but I think this will always depend. We didn't have any problems so far with our borrowers.
Lior, could you please share some further insights around the key trends that you're observing across Europe and across the different hotel markets?
We would say basically, is there one direction? We have seen a lot of luxury products lately. Some of them had good fundamentals. Others had, many of the lenders of the borrowers invested a lot of capex during COVID, but this always depended on let's say, on the equity basis of that borrower. What we can see is now also many five-star products that need a bit of, let's say, capex. We usually we're quite a traditional lender, and we focus on gateway cities and on such luxury products. So I cannot say too much about the resort side, but I know that there are many on the market at the moment. On the other hand, we can also see that the mid-market is coming up again. Why? I think the background is that that corporate travel is increasing again. So therefore, I would say that there are that slowly we're getting back to where we have been originally nearly 5 years ago, I think.
I remember having a conversation with one lender who, probably about 12 months ago, I would say, who challenged or queried the sustainability of ADRs. Could you comment on that, Lior, from a lender perspective? How are you?
I would also agree to that. I think the revenge travel helped many hotel markets to increase their ADRs. To the extent, I think that we are at the peak now, definitely. Are we going down? Not sure. I've seen, for example, the Amsterdam market in Q1 went down from its ADR, but I'm not saying that prices will go down dramatically, but definitely I think we're at a peak. Let's put it this way.
Yeah, thank you. Philippe, let's bring you into the conversation here. And I want to hear your thoughts on, or advice, I should say, on how hotel owners can best position their assets in order to achieve those strong valuations during refinancing.
Yes, thanks, Eloise. I think there are two aspects to that question. The first is I'd say obvious housekeeping. In other words, if you're a borrower, you want to make life easier for the would-be lender. So you want to make sure that your assets are in good order. You want to make sure that they're operating satisfactorily. You've got your costs under control, your operations, your marketing, etc., are working in an optimal fashion. And what you want to be able to do is to give the people who are assessing the loan and assessing the value of the underlying collateral information that reassures them. In other words, shows that your track record of accounting for your various KPIs delivers the kind of results that you've been forecasting, and that your business plan is credible. And that, I'd say, is true in any context, but even more so when financing is more difficult to come by, because you want to make it easy for the people you're dealing with to present the loan to their superiors and get it approved. I think there's another aspect which is perhaps even more important today, and which will remain important post the decline in interest rates, which is that particularly if you have older and slightly idiosyncratic properties, you want to make sure that you've done your homework in terms of energy sufficiency, sustainability, because if you don't deal with that aspect, your lenders are going to find it very difficult to finance you. And that's a growing issue, particularly for a lot of independent hotel owners. That wouldn't have been such a significant factor a few years ago, but it is now, and it will become more so.
Maybe a slight tangent here, but on the sustainability front, who is leading that conversation? Is it the lenders? Do you think it's the owner or the operators, or could that be demand from the guests?
I think in the context of a refinancing discussion, it'll be the lender. The lender will want to know that you've addressed these issues, that you've actually spent the money, or that you have a plan to spend the money that's integrated in your calculations as to the sustainability of the debt and your plans for reimbursing it. And the more work you need to do to the property with the money that you're seeking to borrow, the more demanding the lender will be, both in terms of monitoring the loan, but also in terms of the hurdles you have to jump and the cost they will charge you.
Thanks, Philippe.
I think I'd actually add a little bit to that, on the basis of ultimately this is going to be government regulation that comes down via the banks and then cascaded onto the borrowers.
100%.
And I suppose we've seen a parallel in that in terms of the residential rental market at the minute, where those lower EPCs are really struggling now to get finance.
Dan, sticking with you for a moment here, I'm hoping you're able to provide us an overview as to the types of data pools that hotel owners can leverage in order to strengthen their applications to secure those favourable terms.
Yeah, and I mean, I think Philippe's touched on some of these already, but certainly having a handle on your management information and your accounts is key, and having that in a timely manner, because ultimately you need to be able to act on that quickly, rather than it coming 6 months down the line when it's too late to do anything about it. And generally with hotel clients, we see that management information being a bit more involved. So not just your standard financial KPIs, but also things like your room rates, your wage cost percentages, your margins on your food and drink if they're provided as well. So we see all that feeding in, and the clients that we see being most successful are the ones that don't necessarily have the best KPIs, but understand why their KPIs are performing in the way they do. When they're speaking to lenders, they can tell them that, yeah, in this case it's slightly out of kilter with where we'd like it to be, but it's because of this. We saw minimum wage take a big impact on some of our clients, and they're now working to redress those margins, but that doesn't necessarily happen overnight. So being able to have that conversation with lenders is quite important. Obviously, lenders as well are looking not only backwards to see that track records, but forwards, and having some good quality integrated forecasts, where not only do they set out the best case scenario that you'd like to present, when the lender comes back and asks, well, what about this? What if that happens? Then you're able to answer that and manipulate that data to reflect that as well.
Mm-hmm. Could you give us a description of borrower profiles? And I want to sort of jump off something that Lior mentioned earlier, that he's seeing more new buyers come in, especially first-time buyers. Dan, are there specific borrower profiles that lenders are actively seeking?
I think we're certainly seeing that proven borrowers are finding it slightly easier to borrow. Gary may be able to shed a bit more light on this, but certainly the ones where we're seeing it go through slightly quicker are those ones with proven track records. We are seeing some new to market borrowers, but that does seem to be taking a lot longer, because they're having to get up to speed with that information. They probably lean more heavily on their advisors as well, because they don't have that experience, that track record.
Mm-hmm. Gary, is there anything that you would like to add to that?
To be honest with you, that's absolutely spot on. Yeah, the concept of absolutely delivering a management pack, the financial due diligence, and an exit strategy, crucial with regards to obtaining finance historically, but potentially ever more detail is required in that pack nowadays, because of where the markets have actually moved. Mm-hmm.
And to stick with you, Gary, for the next part of my question, I would like to talk to you about the role of traditional lenders and alternative lenders. What roles are they playing in current conversations?
So affordability of debt is absolutely the critical component of all of the discussions I have with all of my clients. The interest rate environment that we find ourselves in is obviously squeezing cash flows and evidencing of affordability at the present time, adding to the risk profile in comparison to when they potentially took out debt 5 years, 10 years, 15 years ago. Simplistically, traditional versus alternative funding represents a risk curve. Traditional funders very much more at the lower risk end of the sector. Alternative willing to be a little bit more adventurous, but alongside all of that, the pricing profile will rise with the risks attributed to each and every individual transaction. Funding, as a general overview, concentrates on the ability to assess the management team. We've already touched upon the ability to look at a credible, proven, experienced team versus that can deliver and prove that it's delivered financial performance that can demonstrate the ability to afford the debt. Absolutely critical in a refinance proposition right now. And I think that crosses over both on an owner-operator model into investment. The investors should really get underneath the skin of the manager and the effectively the tenant that is going to be in situ to deliver, obviously, hotel performance, which ultimately then delivers the contingent liability of the rent to them.
Mm-hmm. Given that we are seeing that high cost of capital, are you seeing any good examples, or perhaps you can provide some advice here, Gary, on how owners can actually structure their refinancing deals to help manage that interest rate risk?
So again, it sort of repeats on that whole position of looking at funding as a general position, where you need to demonstrate credibility of yourselves as the borrower first and foremost. Absolutely having a handle on your historic financials, current management information, and your business plan moving forwards. That sort of effectively demonstrates the ability to afford the debt. Alongside that, absolutely looking at any trend analysis that we've seen over the last 3 to 4 years. CapEx spend that's potentially gone into your property and your assets during the last 3 to 4 years as well. Absolutely crucial to understand where your operating model is at the present time, possibly any changes that you're looking to bring into the mix, particularly if we are potentially looking at a proposal where affordability is possibly being brought into question, and therefore we are possibly needing to consider a change of operating model to deliver better profitability to then subsequently afford the debt requirements that are being looked for.
Mm-hmm. Thanks, Gary. I'm going to quickly share a reminder to the audience that if there are any questions, please use the Q&A function at the bottom of your screens, or even use the chat function to submit your questions, and I will get round to asking those either when relevant or towards the end of today's discussion. I want to move on to talk about LTV ratios, and Lior, you mentioned that you're seeing LTVs of around 52%. How, generally speaking, how are these ratios for financing or refinancing deals trending in the current environment?
I would say they went when COVID started, they went down to, let's say, 50 to 55%. So that was that's what we were seeing. That was quite drastic from the level they came from. And now we are seeing them going up slowly again towards, I would say now 55 to 60%, and in some instances even up to 65%. This will, of course, always depend on location, the quality of cash flows, and so on. But I think definitely there's the trend that less equity will be required by borrowers if they go into new, let's say, financings, depending always on the quality of the product.
Mm-hmm. And do you see this changing in the short, medium, perhaps long term? And if so, what impact do you think this is going to have on owners?
Well, LTVs will definitely, if LTVs are going up, this means basically that there's more equity people can use for something else, borrowers. But we definitely see that. Like, we've seen this, let's say, that LTVs change is usually not happening overnight, but over a longer period. And if I take it from, let's say, 2 years ago, I think it was strictly at 50%. And now we go towards 60% and slowly 65%. So that's that's the trend I can see. But LTVs usually don't change overnight. So this is usually a period that takes longer.
Mm-hmm. And I would like to bring Philippe in just in here and ask him his thoughts. I mean, what do you think on this, Philippe? Do you see LTVs changing in the short to medium long term? What's your take on the market right now?
Thanks, Eloise. I mean, obviously, I agree with Lior that we're seeing, if you want, an unwinding of the process that we went through, or the beginning of the unwinding of the process we went through as interest rates went up. In other words, as they start to come down, or as expectations and the yield curve that they will come down become established in all parties' minds, then you see LTVs going up. For the simple reason that the same loan, if the interest cost goes down, sees its interest coverage ratio improve. And so obviously that's another factor that inevitably gives more comfort to borrower and lender as to the sustainability of any given debt. And I think the next shoe to drop should be, and we're beginning to see that, I think, more deal activity. We've all seen reports in the press and elsewhere about the KKR deal in the UK. There's been talk of Blackstone and Village Hotels also in the UK. These are substantial transactions which are apparently in the offing and being run by private equity firms, which, even if they're doing this through a value add strategy rather than an opportunistic one, and I don't know the ins and outs of either of those transactions, so I'm just talking in theoretical terms, using them as examples, they will be relying on the debt markets, and they could afford to do them full equity, but my suspicion is that either at the time of the transaction or when they, after they've consummated the acquisition, they will want to refinance, and they will factor that into their calculations as to the kind of price they might be willing to pay for those portfolios. Those transactions lead us to think that, for good portfolios, good underlying assets, and strong borrowers, refinancing is definitely available again to a greater extent than it was a few months ago.
Philippe, you touched on it just a moment ago, and I'm assuming that I am right to say yes, but do you think then that refinancing might pave the way for increased M&A activity?
My sense is that we're beginning to see that already. Again, early days, but anecdotal evidence, reports in the press about transactions, conversations with people in the market lead one to think that there's definitely an expectation that this is the trend. But obviously people like Lior and Gary and Dan, who are involved in transactions and financings right now, are probably better placed to judge that. But that's definitely the impression I'm getting.
Mm-hmm. Let's open this up then to the remainder of the panelists then. Do we think refinancing will lead the way for more M&A activity? Or perhaps to rephrase, what is your outlook on transaction activity? I'll move to left to right as per my screen. So Gary, over to you first.
I think on a general overview basis, rather than concentrating on M&A, I think what we're going to see is that, for me personally, I think there's a level of retrenchment by the traditional lenders, which is therefore squeezing the market somewhat with regards to where funding is actually available. I've seen opportunities arising in the recent past where high street funders have actually turned around and said, actually, you're now in breach of covenants. Can you either refinance, or can you actually introduce equity or additional cash to reduce your loan to value to make certain that you're coming back within covenants? Which obviously then opens up the conversations for myself and fellow professionals across the sector to open up refinancing discussions with those clients, understand whether they've got equity, whether there's other sources of top sliced solutions, whether it be mezzanine or coupon, preference shares, equity coming into the transaction. The senior debt provider would obviously need to understand all of that detail based on an exit strategy further down the line as well. So I think there's an awful lot to look at the present time, given the possible solutions, and hopefully solutions can be found with regards to that refinancing position rather than the worst case scenario of having to exit by sale.
Mm-hmm. Lior, what are your observations at the moment regarding refinancing, M&A, transaction volumes, etc.?
Just to add something to what Gary just said, I think it's always, when it comes back to the LTV, it's always a bit of a difficult thing. If you increase LTV too much, then you might always come to as soon as prices go up again or down again. The problem is that LTV also, you have to pay down the loan again to a certain level. Demand for loans is definitely there, but it always comes back down to the sponsor, the quality, what's the background of them? Do we have long-term relationships? So money is definitely available, but it will always depend on the individual circumstances. I mean, even for a first timer, if he has, for example, if he has a solid equity base, then we would, of course, also go for such borrowers. So I want to say that funds are definitely available.
Mm-hmm. Thanks, Lior. Dan, your thoughts, please.
Yeah, I think we're certainly seeing the transaction volume increasing. We're also seeing or anticipating that some of those transactions that have taken place over the last couple of years at higher rates will also ultimately be coming around for a refinance, where they were what you'd probably call marginal at the time. You know, very marginal in terms of the affordability. But the ultimate exit strategy was always to refinance, you know, a couple of years down the line to bring those, you know, to a more affordable level. So I think that's sort of where we're seeing, you know, some of those transactions coming in, as well as, you know, the wider M&A market, where there does seem to be an increase in certainly deal inquiries, if nothing else.
Mm. And Dan, sticking with you, for those owners that might be looking to sell, considering selling their properties, how can refinancing strategies be used to maximize the value in a potential sale? What's your advice here?
Well, I think the first thing I'd say is to get the debt in the correct structure, if you like, the structure that works best for the business. I think you touched on earlier about you know, having to change the way you operate in order to service you know, service that debt, and that's by no means a healthy position to be in. You want the debt to work for the business, and you want to make business-driven decisions rather than debt-driven decisions. You know, for example, I've seen businesses in the past where they're operating in a certain way just to meet covenants, but they could be making more money doing it in a different way. And you know, the market was as such at the time that they weren't able to open that conversation with the lender and say, like, actually, this isn't working for us. So having those, you know, being able to structure that debt in the way that works best for the business, effectively allows you then to maximize your valuation by increasing you know, your EBITDA ultimately, which is typically how businesses in this sector are valued.
Mm-hmm. And Gary, you mentioned you talked about covenants earlier in the conversation. How do these existing loan covenants typically affect the saleability of a hotel? And what would be your advice to better mitigate, navigate, manage that?
So vendor loan covenants, if not breached, I think would typically demonstrate a robust hotel, and therefore should have little or no impact on saleability. However, if the vendor's debt position is zero or low, and the actual performance of the hotel is not demonstrating sufficient affordability of the buyer's proposed debt profile, that's obviously going to reduce the buyer pool, and could therefore impact on the actual price of the asset. If obviously we are looking at breach of covenants from the vendor, ultimately therefore possibly looking at a distressed sale, again, we're possibly looking at a different buyer pool, possibly a reduced buyer pool further again, and under a distressed scenario, obviously the impact on asking price will potentially be significant. Mm-hmm. Moving further forwards with regards to best advice, ultimately, I think engage with fellow peers, consultants, advisors, your lender, to essentially assess how the business can be improved to best position the business for both refinance opportunities in the future and or possible sale if required.
Mm-hmm. We've had a conversation excuse me, a question come in from the audience around the minimum loan amounts that you would typically look at for independent hotels. Would someone be willing to comment either from a personal perspective or perhaps generally what you're seeing in the market around loan amounts for independent hotels?
Maybe I can.
I'll have.
Sorry,
go on, Lior.
Go ahead, Gary.
Gary first, and then we'll move over to Lior.
So, Christie Finance, we've got a broad function providing unsecured debt, our standard core offering, which essentially aligns with our Christie & Co sales agents and valuations teams. So we'll go to the market. Our core function will actually look at anything from 250k up to typically 5 mil. I work in our debt advisory function, which typically comes in at 5 mil and above.
Mm-hmm. Thanks, Gary. And Lior?
I would say there are different lenders for different loan amounts. So basically, like the regional banks or the local banks, they usually go for a loan amount up to, let's say, 5 to 10 million, and then there's some little consortia, and we do quite large loans. I think the average loan we have, I've seen, is like around 100 million. This also includes individual loans and portfolios. So therefore, for example, if it's, let's say, a more complex transaction, which is between several countries, then you would go for someone like us. But I would say that there's a bank that serves every loan amount. Let's put it this way.
Mm-hmm.
Yeah.
Yeah, and I think sometimes there's also alternative ways of funding that. So one thing we've done with a few of my clients is locally available grant funding sometimes for certain projects. So, you know, be it they're putting in some solar panels or, you know, a more energy efficient boiler, something like that. There's often grant funding available, which can then couple with one of those, you know, lower value loans potentially.
Mm-hmm. I would like to end this conversation with some final words of advice, and I'm actually going to broaden this advice. It could be commentary, it could be insight, tips, how you would like to package your final words to our hotelier investor audience today. Dan, I will kick off with yourself, and then we will move back along the line. So Dan.
So I suppose my top tip, if you like, would be to make sure your house is in order. I've already touched on this, but good quality financial information and good quality forecasts is key. Having that packaged up, ultimately making the lender's job easy, as easy as possible, is you know, a good way to get success, really.
Mm-hmm. Thanks, Dan. Lior?
I would say in general, pencil in more time for deals these days, and also maybe involve your bank or financial advisor earlier, because transactions take longer. And the second thing is, if you experience any, let's say, potential problems as a borrower, involve your bank early, because it's not in our interest that borrowers fail. It's actually more in our interest to help them to find a way how to solve the situation.
Mm-hmm. Thanks, Lior. Philippe?
I would say it's important to shop around, and it's important to have an advisor who's active in the market pretty much constantly, certainly currently, because the landscape of lenders evolves over time. So obviously you've got the banks, the debt funds, but to give you an example, only very recently, Ian Livingston of L&R was talking about the fact that he thought, and he's active globally, that there was definitely a financing gap. And he was beginning to think, or his firm was beginning to think, in terms of credit opportunities, which, as far as I know, is not something they've done that much of in the past. And they're very savvy investors. So if they're looking at that opportunity, there's a dialogue to be had for the right kind of assets, the right kind of portfolio. And that's just one example. There are plenty of others that one could think of. So make sure that you shop around and talk to a number of people who are relevant to your needs. And that's where your advisor, if he's active in the market, will be able to help.
Thanks, Philip. Gary, your take, please.
I'd agree entirely with Philip on that one. Ultimately, the number of additional private equity credit funds, family funds that are coming to the market absolutely crucial to have an understanding of the overall proposal. And dare I say it, in line with what Dan said, for me to actually get a credit sanction, it is fundamentally underpinned by detailed due diligence, both historic and business plan moving forwards, with a real detailed understanding as to the trends behind your historic performance, and if there is a change in your operating model, how you are actually going to deliver that. So it's that whole credibility piece of yourself as the borrower that underpins the direction of how best to get the best rates for your refinance, and ultimately finding the best borrower for your needs as well.
Thank you.
Or lender.
Thanks, Gary. I'm just going to flag here that we're going to leave this webinar open for an extra 2 minutes at the end, so that all our audience members can follow up on any of the links that we have popped into the chat today. As I mentioned at the top of our conversation, all the LinkedIn profiles of our speakers have been popped into the chat, and I would encourage you all to pick up this conversation after today's webinar, because I'm sure there's more that we can cover. In fact, we've just had a question come in from the audience, so whilst we're here, let's crack on. Why is the process taking much longer? And I believe this is on the transaction side. Lior, I think you mentioned that transactions are taking longer. Why?
I believe that there are several reasons for that. First of all, it's very often something that is out of our hands, which is usually the discussion between the owner and the potential borrower, so buyer. So this is something that is out of our hands. You know, there are many more regulations that since this started, I think, in 2007, and there are more and more regulations coming over time, meaning more things we need to ask our borrowers and so on. And that's what we can see. And also there's a difference if you're having an experienced borrower that has done business with us, you have a template which you can reproduce. And if it's what we also see, especially with new time borrowers in the hotel sector, LMA standard and so on is something new for them. So this is also something that will take them time. So if you're unexperienced, trust your lawyers and their advice. And yeah, I think these are the reasons which cause a longer process.
Thank you. Thank you to Lior, to Daniel, to Philippe, to Gary. Really appreciate your thoughts, comments and insights shared today. I just have a couple of slides that I would like to run through before we finish off today. And like I said, we'll keep this webinar open at the end for you to follow up on any of the links that we have popped into the chat. If I can please ask my team to bring up the next slides, please, that would be fantastic. A selfish plug here, the next Boutique Hotel News webinar is taking place a week today on June the 17th, where we're going to be discussing leveraging new distribution channels. We would love to see you there. The link to register has been popped into the chat. And if you're interested in working with us, either across our digital events, such as this webinar series, or perhaps our in-person events too. For example, we've got the Urban Living Festival coming up soon in September here in London. Please get in touch with my colleague Piers. His details are up on your screen and they have also been popped into the chat. All that's left for me to do now is to say thank you to our speakers, thank you to Agilysys for kindly sponsoring, and thank you to our audience members for tuning in and submitting your questions. Do enjoy the rest of your afternoons, and I look forward to seeing you all again in about 1 week's time. Thank you and take care. Bye-bye.